Over the last decade, a new digital asset class minted billionaires practically overnight. But sudden, multi-billion-dollar collapses also wiped out ordinary investors without warning. If this digital ecosystem is so volatile and complex, why did anyone bother to build it in the first place? To answer that, you have to look at how traditional money works. Every time you swipe a card or wire a payment, you rely on a central authority, like a bank or a clearinghouse, to verify that you actually have the money and to update the ledger. Because the entire system relies on that central point of trust, regular users are stuck paying whatever fees the intermediary demands and are completely vulnerable if that single institution fails or decides to freeze their account. In 2009, an anonymous author or group named Satoshi Nakamoto proposed a short rebellion against that exact system. The goal was a true peer-to-peer electronic cash network. Look at how this network shifts. Instead of relying on a single central bank to hold the private ledger, a blockchain distributes identical copies of a public ledger across a vast web of independent computers, called nodes. As the network rapidly exchanges data, new transactions are grouped together into blocks. The computers race to verify the math, and once they reach a consensus, the new block is cryptographically linked to the one before it, snapping permanently into place so the history can never be retroactively rewritten. To access funds on this network, users rely on cryptographic private keys, complex digital passwords. If you hold the private key, you alone authorize the spending. No bank permission is required. By proving that a decentralized network could successfully agree on a shared reality, this technology showed that humanity could securely move value across the globe without ever relying on a middleman. Over time, developers expanded on this concept. Platforms like Ethereum introduced smart contracts, which are pieces of code stored directly on the blockchain that automatically execute agreements when specific conditions are met. These self-executing contracts birthed decentralized finance, or DeFi. Suddenly, users could lend, borrow, and trade entirely through code, bypassing traditional loan officers. But there is a massive contradiction in how this market operates today. To actually buy the tokens needed to access this decentralized world, the vast majority of people use centralized exchanges, companies like Coinbase or Binance. These platforms function exactly like traditional brokerages. When you deposit money with them, they hold your private keys on your behalf, match your buy and sell orders, and act as the exact kind of intermediary the original white paper rebelled against. By training the burden of self-custody for the convenience of an app, the industry rebuilt the exact centralized vulnerabilities it was designed to destroy. That vulnerability carries severe risk. When you leave your keys with a third party, your funds can disappear if the platform is fraudulent or poorly managed. In 2022, the collapse of the centralized exchange FTX erased billions of dollars in customer deposits almost overnight. To navigate this extreme volatility, traders rely heavily on stablecoins, digital tokens designed to hold a steady value, usually pegged one-to-one with the US dollar, acting as the backbone for trading across different platforms. But as this animation shows, a failure in that backbone triggers massive contagion. When the algorithmic stablecoin Terra USD, which lacked actual cash reserves, lost its dollar peg, it collapsed entirely, dragging down dozens of connected lending platforms and erasing tens of billions of dollars in days. Even the underlying networks have deep structural flaws. Despite the ideal of total decentralization, the computing power, protocol governance, and actual token wealth are heavily concentrated among a very small group of large operators. The reality of the crypto market diverged from the utopian vision. Ultimately, it simply became a highly concentrated, loosely regulated casino where everyday users bear all the systemic risk. That era of unregulated anonymous finance is rapidly coming to an end. Regulators globally are aggressively stepping in to force compliance and establish consumer protections. Look at the sheer institutional weight bearing down on the industry. The U.S. Securities and Exchange Commission has launched sweeping enforcement actions against major exchanges, while the European Union has rolled out a comprehensive licensing and disclosure framework known as MiCA. Governments are also taking the underlying technology and adapting it for themselves. As you can see on this phone displaying the digital yuan interface, countries are developing their own central bank digital currencies, creating state-issued money that runs on blockchain rails. Between strict know-your-customer rules, aggressive tax reporting, and state-monitored digital money, the borders of this once rebellious ecosystem are being completely enclosed by traditional legal frameworks. The traditional financial system did not collapse under the weight of this new technology. It simply absorbed it. Today, Wall Street institutions are the dominant players. They offer everyday investors regulated spot Bitcoin and Ethereum exchange-traded funds, allowing people to buy exposure to crypto prices directly through their standard retirement accounts. Major banks are pushing even further through a process called tokenization. They are issuing digital versions of traditional, real-world assets, like government bonds and private funds, on the blockchain to settle trades faster and cut administrative costs. It is crucial to understand that institutional adoption does not erase the danger. Cryptocurrency markets remain highly speculative, prone to extreme volatility, and you should always independently verify the risks before making any financial decision. Cryptocurrency is no longer an anti-bank rebellion. Over the last 15 years, it matured into the newest, riskiest, and most deeply integrated technological layer of the global financial machine.